This is trade. Why is it coming to one line? I did not separate it like that. Good. So these trade receivables, we also add what the parent has 100%, and we add it to what the subsidiary is bringing over. Simple like that. We just add the parent and subsidiary. Now, this is the pro forma. This is the pro forma. Sorry, why am I writing trade receivables? It should be trade payables or creditors. I really love receivables, but everyone loves receivables anyway. Who wants to pay? Everyone loves to receive. Good. Now, this is our pro forma consolidated statement of financial position. This is consolidated statement of financial position. This is the pro forma. Now, after putting up this pro forma, now you know you've already harvested the marks that you can get, and the only thing you need to do is just to introduce a column. Introduce a column for the totals, and then you add the total equity liabilities and the total assets. So let me just put there total assets, and this one is total equity and liabilities. Total equity and liabilities, very fast like that. And there, I will put that double underline. That double underline. Like that. So here, we can either use the second column or just do it in one column. There is really no harm at all. No harm at all. No harm at all. No harm at all. We can just do like that, so that we can always see the totals that we are having at any given point in time, so that we see, because we know our balance sheet should be balancing, but really that is not our intention. It doesn't have to balance. We just want to maximize on the number of entries. So let me introduce some space here. Like that. So now, guys, let us look at the additional information. Let us go to additional information. Additional information, and I would want us to start from additional information number 2. I want us to start from number 2. And the reason why I'm saying we start from number 2, even if you start from number 1, there is no problem. But number 2 is very straightforward. Additional information number 2 says, on 1st of January 2017, Kenya Airways owned some items of equipment with a book value of 45 million that had a fair value of 57 million. There are two things that have been introduced there. They are talking about book value, and they're talking about fair value. A book value of 45 million and a fair value of 57 million. These assets were originally purchased by Kenya Airways on 1st of January 2015 and are being depreciated over 6 years. Yes, when were they bought? 1st of January 2015, and they're being depreciated over 6 years. Now, the reason why I've written book value and fair value is to help you in interpreting these things. Now, book value is the value in which the assets appears in the books. Fair value is also the same as market value. Yes, the value in which those items, those assets can be sold in the market. Their market value at the moment, their current market value is also called the book value. Now, you know that where a book value is greater than the fair value or the market value, if the book value will turn out to be greater than fair value, you realize that the value of those assets, is a negative revaluation, and we can just use depreciation. It has depreciated, or that is a negative revaluation, a negative fair value adjustment. But where the fair value is greater than the book value, if the market value is greater than the book value, then that one is a positive revaluation. And that one, we call it positive fair value adjustment. That is a positive revaluation, positive fair value adjustment. And I believe those are things that you know. So let us look at that, what the examiner is giving us in that additional information number 2. So the examiner is saying that this KQ, and we know Kenya Airways is the subsidiary of Adani. And this Kenya Airways owned some items of equipment with a book value of 45 million and at a fair value of 57 million. Is this an upward revaluation, or this one is a downward revaluation? Is it a positive fair value adjustment or a negative one? Somebody? Book value is 45, fair value is 57. What does it mean? Yes, it is a positive. Yes, it's a positive fair value adjustment, or an upward revaluation, or we can call it revaluation gain. We can call it revaluation gain. So how do we treat revaluation gain? Meaning this asset's value is higher than what was recorded in the books. If the asset's value is higher than what was recorded in the books, then we add that revaluation gain to the PPE. We add the revaluation gain to the PPE. So here I will come to PPE and I will add the revaluation gain. Well, how much is the revaluation gain? It is the 50 what? 57 minus 45. How much is that? The revaluation gain is 12 million. So I will add 12 million to the value of PPE. That is the revaluation gain. After that, I will continue reading. What is the examiner continuing to say? These assets were originally purchased by Kenya Airways on 1st of January 2015 and are being depreciated over 6 years. That one now comes in as a working, and let me just put the working one so that you're able to see what the examiner is talking about. So we are talking about valuation gain or fair value adjustment, good. Fair value adjustment, like that. So we've already seen that the revaluation gain there is equal to 57, and we've subtracted 45. I believe you all see where we are getting 57 and 45 in that additional information number 2. So there is something they're bringing over. They're saying that these assets were bought on 1st of January 2015. So 1st of January 2015, and it was supposed to be depreciated over 6 years from the date of purchase. And are being depreciated over 6 years. So the date of purchase is 1st of January 2015, and they're depreciated over 6 years from that date of purchase. Now, what does that tell us? That tells us that this revaluation gain, the value of the revaluation gain, we have to subject it to depreciation, because you know our date of financial statements, and now we know the date when these things were purchased. Date of our financial statement is when? When is the date of our financial statements? We know that we are not looking at the date of financial statements, but the date of acquisition. Sorry, date of acquisition. We're talking about a subsidiary. When was the subsidiary acquired? Subsidiary was acquired on 1st of January 2017. Look at our group structure and you'll be able to see that. This one here, date of acquisition, 1st of January 2017. So if it was supposed to be depreciated for 6 years, I want you to be very keen, because there is a very, very serious concept here that you should not miss out. We've gotten our evaluation gain, and we are told that from the date of purchase, which was 1st of January 2015, to the date of acquisition, what is the period from the date of purchase of this asset to the date when this subsidiary was acquired? From 1st of January 2015 to 1st of January 2017, date of purchase of the asset and date of when the subsidiary was acquired. This one, 2 years has elapsed. Why is someone saying 3? From 2015 to 2017, remember they are both January, so we are counting the whole of 2015, the whole of 2016, 2015, 2016, let me look at that, 1st of January 2017. It is 3 years, 1st January 2017. And then let me confirm also the date of purchase of the asset. The asset was bought 1st of January 2015. Good. I get you. Now, we count the whole of 2015 when the asset was purchased, and then we count the whole of 2016. Remember, 2017, this is January, 1st of January, meaning we do not count 2017. I believe you're getting it. From 2015 January to 2017 January, we do not count the 2017 because this was just the start. So this asset, they stayed with this asset for 2 years. I believe you guys are getting it. 2 years. It is not 3. 2015 and 2016, because when we are starting 2017, that is now when the acquisition happened. So we do not count the 2017 one. We only take 2015 and 2016, 2 full years. But 2017, we do not count it. It is just from the start. Now, that is 2 years. Now, if the revaluation gain is 12 million, and from the date of purchase, date of acquisition, 2 years had elapsed. And when it was purchased, it was supposed to be depreciated over 6 years. Someone has unmuted, and it is making some noise here. All right. So it has 2 years has elapsed. Now, what is the formula of getting depreciation on revaluation or depreciation on fair value adjustment? What is the formula? Depreciation on revaluation, or you can call it depreciation on fair value adjustment. What is the formula? Somebody? This formula should be known by you at the moment. People, you should be knowing this formula. You should be having the formula. How do you get depreciation on fair value adjustment? I believe these concepts, you covered them in class, so that should not be a problem. Depreciation on fair value adjustment. No one is talking. No one is talking. People are quiet. People are quiet. Amount divided by number of years. I see JMK telling us that. Amount divided by number of years. Somebody else to try. What is this FBA? I don't know the full meaning of FBA. Derek? FBA. Fair value adjustment divided by rule. Very good. Very good, very good, very good. Derek has mentioned something I was looking for. Now, guys, when you want to calculate depreciation on revaluation or depreciation on fair value adjustment, it is the revaluation amount. Revaluation amount The reason why I'm using revaluation amount is because this one, you'll not forget if you use that revaluation amount one. Divide by remaining useful life, or you can call it rule. Remaining useful life, rule. That is the short form of that. So it is the revaluation amount or the fair value adjustment divided by rule. That's how you get depreciation on revaluation. Now, how do we get it? Very fast, now we go here and say, our revaluation amount was 12 million. I believe we all remember how we got it. Then we divide that by the remaining useful life. Now, this asset was bought on 1st of January 2015, and it was supposed to be depreciated for 6 years. But since the purchase, between the purchase and date of acquisition of this subsidiary, 2 years had elapsed. And I believe you know how we've gotten the 2 years. 2 years had elapsed. Now, what is the remaining useful life of this asset? This concept, I want you to understand it. What is the remaining useful life? It was bought in 2015. It was supposed to be depreciated for 6 years. But after it was bought, 2 years later, this subsidiary was acquired. 2 years had elapsed, but the total was 6. So how many years are remaining? 4. Good. Thank you. Thank you. Thank you. I'm glad that you've gotten it. I'm glad that we are together there. So that means 2 years had elapsed. If the total was 6 years for depreciation and 2 years is already gone, the remaining useful life is now 4 years. So if you divide that revaluation gain of 12 million by now the 4 years which are remaining, you are going to get 3 million. 3 million is the revaluation, is the depreciation on that revaluation. But now, remember, we want to look at accumulated depreciation, total accumulated depreciation. This one is a depreciation per annum. This one is a depreciation per annum. The 3 million is the depreciation per annum on that asset. This one here, the 3 million is depreciation per annum. But the figure we are supposed to take to the statement of financial position should be an accumulated depreciation. How do we get accumulated depreciation? I want you to compare. Now, the asset was bought in 2015. We acquired this subsidiary in 2017. 2 years had elapsed. That's how we were able to get the remaining useful life of 4 years, which is 6 minus 2 years. Now, we are looking at from the date of acquisition now to the date of financial statements. How many years are those? Go back to our group structure here. Our group structure will give you that very easily. You realize the date of acquisition was 1st of January 2017, and date of financial statements is 31st of December 2019. So this subsidiary and the parent traded together for 3 years. They were members of this group for 3 years. So that 3 years, we have to get the accumulated depreciation of this asset. We've gotten depreciation per annum, which is 3 million. And now, if in 1 year depreciation is 3 million, how much depreciation? What is the total depreciation for the 3 years that they stayed together? That gives us 9. That is the total depreciation, total accumulated depreciation of that asset. I believe, guys, you've understood that concept. Like I started by telling you, understanding the concept is most important. Most important. I believe we are together. I believe we are together. So this total accumulated depreciation of 9 million, we will deduct it from the PPE figure. I believe you remember we added the PPE for the parent and the subsidiary. We added that revaluation gain, and now there is that accumulated depreciation on that very asset of 9 million. We deduct it from there, like that. I believe we are together there. So that wraps up additional information number 2, which is falling under our working one. I can just even write it note 2. Note 2, so that it doesn't confuse you, note 2. So I want us now to go to note 1. We started with the easier one, which was note 2. So let's come to note 1 and look at it. I'm not saying note 1 is difficult, it is not. But note 2 was too direct, so that's why I decided we go with it, and it had a very nice concept there. It had a very nice concept. So note 1, I want us to go to note 1 and see what it says. On 30th of November 2019, Adani sold goods to Kenya Airways for cash 32 million. These goods had originally cost 22 million, and none had been sold by the year end. On the same date, Adani also sold goods to KPLC for 22 million. These goods originally cost 10 million, and KPLC had sold half by the year end. Now, there are 2 things here. This one is intergroup trading, intergroup sales. So let me just even note it here very fast. Intragroup sales, intragroup sales. There is a rule which I believe you know, and you covered it, that any intragroup transaction must be eliminated in full. That is something I believe you remember. You must eliminate intragroup transaction in full, intragroup sales. So if we look at here, there are twofold trade. There is a trade between the parent and subsidiary, And then the parent also traded with the associate. The parent traded with subsidiary and traded with the associate in this additional information number 1. Now, let us start from the first one. Let us start from the first one. The Adani, who is the parent, sold goods to Kenya Airways, who is the subsidiary, for 32 million. But the cost of these goods that the parent sold was 22 million. Now, this is a very direct question here, because our interest, what are we looking for here? We are looking for unrealized profit on stock, UPS. We are looking at UPS, unrealized profit on stock, because you cannot sell to yourself. Subsidiary and the parent are members of one group, and therefore the parent cannot purport to make profit when it sells to itself, to its branch. So that's why we have to deduct this UPS. We have to get rid of it from inventory, because that is fake. That is a fake profit. How do we get it? There is always a way that we calculate unrealized profit on stock, and you know that there is this formula which normally says unrealized profit on stock is normally profit margin. It is normally profit margin. You multiply it by remaining intra-sales. You multiply it by RIS. You multiply it by RIS. But in this case, the examiner has made our work very easy. We are not going that long direction. We will not even bother ourselves looking at the profit margin, because that is not given. But it is good to remember that formula so that whenever it is given, you know what to do. Now, here, the examiner gave us this indirect, and we can easily get our UPS. Our UPS, we can get it very easily. How do we get it? Let's go back here. Because we've been given the cost of the goods that were sold, and we've been given the amount that was realized. These goods had originally cost 22 million, but they were sold for 32 million. So the parent sold them at 32 million to the subsidiary, but the goods had costed 22 million. So the UPS there is 10. Very direct and very easy. I believe you can see that. So the UPS is 10. Now, how do we work with this 10? I'm still dealing with the parent and subsidiary. The one for parent and associate, I've kept it aside kidogo kwanza. I've left it aside. I've not looked at this transaction. I'm still using this one here. We've gotten our UPS, our unrealized profit on stock. Now, how do we adjust unrealized profit on stock to our consolidated statement of financial position? I want somebody to, what is RIS? RIS is remaining intra-sales. RIS is remaining intra-sales. Let me just, remaining intra-sales. I want to demonstrate for you the RIS in the second part here, where the parent sold the goods to associate. I'll bring it there. So how do we treat this unrealized profit on stock where the parent sold to the subsidiary? Somebody, less from inventory. That is very correct. That is very correct. Good. Thank you, members. I see people, we are doing well. Now, this unrealized profit on stock, we are going to deduct it from our consolidated inventory, our inventory figure in the consolidated statement of financial position here. So I'm going to deduct, let me just refer to it, the 10, so that I think I've deducted it from here, have I? Yes, that is correct. So we deducted from our inventory figure like that. Now, let us move to the second part. And the second part, you can see that it was a downstream transaction from the parent to the associate. This part, in this additional information number 1, where we are told on the same date, Adani also sold goods to KPLC. This is the parent to associate for cash 22 million. And these goods had originally cost 10 million. So you can also see there is an element of UPS here between 22 million, which is the cash realized, and the cost of 10 million. And we are told, but this associate, which is KPLC, had only sold half by the year end. Now, someone was asking, what is RIS? What is remaining intra-sales? Now, if the total value of goods that were sold to this associate was 10 million, and they realized 22 million, meaning what is the profit there? What is the UPS? UPS in this case here, if I can go ahead and do it here, is the parent sold the goods to the associate at 22 million. Yeah, this was the cash that they realized, but the goods that were sold was worth only 10 million. So what is was 10 million. What is now the UPS? Unrealized profit is 12 million. But remember, we are being told this associate had only sold half by the year end, meaning that is the remaining intra-sales. Intra-sales is the sales between group members. Intra, it is the sales between group members. Now, when we talk about remaining intra-sales, we are talking about that sale between group members, but not all the items supplied was sold by the year end, by the date of the financial statement. So we get the UPS, but we only take the portion of the goods that were remaining by year end. That is how this formula is coming in. You see this formula? This is this formula that I gave you here, where we only take the portion of remaining intra-sales. And in this case, we are told half of the goods had not been sold by year end. So we can just multiply that by 0.5 or just take half of it. And that gives us the 6 million. That 6 million is the UPS between the parent and associate. But I will highlight this. I believe someone who is following, you know why I'm highlighting that. Parent and associate, 6 million. The reason why I'm highlighting it is because you do not bring the UPS between the parent and associate to the consolidated statement of financial position. Why? We are not consolidating an associate. We are only consolidating subsidiary. This one will only affect investment in associate. So I'm highlighting it because you're going to use it when calculating investment in associate. Good. Note number 1, we are done. Let's go to note number 3. Note number 3. Guys, I want you to understand this concept because once you understand it here, you are going to use it whenever you get a question from the same area, you borrow the same concept. It will always remain constant and you will score your marks and you go home happy. You will go home happy. CPA Kin, you got 2.4, not 6. Yes, 2.4 is okay, but now you are running too fast. You are ahead. We will get there. Don't worry. Don't worry.